This is Charles Hoy with Deep Future Analytics and Prescient Models. It's my pleasure today to introduce Dr. Joseph Breeden, the CEO of Prescient Models and Deep Future Analytics, and also the president of the Model Risk Management International Association. Joe's written over 50 trade publications and books, including Reinventing Retail Lending Analytics, and a couple books on CECL, Living with CECL, Mortgage Model Alternatives, and Living with CECL, the Modeling Dictionary. So here's Dr. Joseph Breeden, and have a good webinar. Thank you.
Thanks, Charles, and thank you everyone for joining today. I appreciate the interest in the topic. I know it's much more important than the usual thing we might talk about when it comes to modeling. Today the goal is to check on where we are, what we know, what we don't know, the stress testing view of things, what are the alternatives. We gave a webinar, it's been about 2 months ago, on the initial views of what might be coming. And the reason I gave that webinar back then is that for the last 25 years, honestly, crises around the world have kind of been my career. I was in Hong Kong I was working was fortunate to get to do that work remotely, to be honest. But I've also been involved in many other crisis modeling events, both before and since. And so that's why I've been giving these webinars and doing the writing I've been doing, because this is basically what I do. I've been asked very recently, is this crisis analogous to anything else we can look at? How do we compare it to 2009? How do we compare it to Hong Kong and so forth? And yes, we can bound it by looking at certain other events, and these days people are even looking back at the Great Depression to try to figure out what the boundaries are. But there's nothing exactly like this. This is more than Hurricane Katrina, a true natural disaster. Hurricanes come on slowly, they affect a long time to recover, but there's no such thing as a national hurricane. And this is a global impact. In fact, the IMF has been releasing their estimates, and they're predicting something on the order of a 5% GDP contraction over the next year globally, and the GDP globally won't return to 2019 levels until 2021. That is unprecedented within our data. So we're left with trying to piece things together, making the best estimates we can, and policy is very important to all of this. What will our governments, both federal, state, local, what will they all do in response to this? That's a very hard thing to guess, because honestly, most of them don't know yet. They have to wait and see. So I'm going to walk through the data and what this can mean to our portfolios. So here we go. Let's start with, where are we now? Well, this is yesterday, and probably plenty of you have been doing the same thing I've been doing, which is refreshing this page every day. And I've been doing this since January because, as you probably heard before, I have friends in China who were giving me updates as far back as January, and reading the articles back in January about what was coming, and it was clear that this wasn't going to end quickly. But there's a lot of things wrong with this too. As a data scientist, this is actually a very pretty view on some pretty terrible data, and I'm going to take a minute to explain why, because this is, in my opinion, this is the first truly data-driven crisis we've ever had. We are getting real-time updates on what's going on, and we're trying to make decisions, both big and small, on how to respond to all this based on data. Let me show you why that data is so terrible. This is a simple graph taken from the data on that previous page, and it just shows cumulative US deaths due to COVID-19. So we started to record deaths back in February, and of course, this is scale, are growing exponentially. You're going to see a straight line. Fortunately, the last week shows a little turnover in that line. That's good news. We're no longer on an exponential path. But we also talk a lot about cases. So here's the data on number of people who tested positive. Now the right number to look at is how many people tested positive 23 days earlier, because the average time to die from COVID-19 is 23 to 24 days. Now, no data is perfect, and the number of deaths is not perfect. The CDC is trying to catch up by backfilling cases where they think people probably had COVID-19. They're revising those numbers. But deaths are probably fairly accurate. But in this graph, I'm trying to give you a moment to digest this graph. The orange line is supposed to be above the blue line as number of deaths. The orange line shows how many people supposedly had the disease 23 days earlier. And this would say that we have a 200% mortality rate, which means twice as many people are dying from it as actually have it. Okay, this is all absurd. And in fact, if you study the number of cases tested, it's pretty clear that we've simply maxed out on how many people can be tested. And so we're still catching up relative to the number of deaths. Now, you saw on the previous screen, we have more confirmed cases, around 600,000 in the US than we do deaths. But you have to remember this 3-week lag. In fact, I was talking to a friend this week in New York. I asked where they were because they were planning to leave New York. Well, he got sick, so his family couldn't leave. And he tested virus. With the rest of his family sick, they took them back to get tested as well and were told, of course they have it. Go home. We're not testing you. And you hear stories like that all over, that if they know you've got it, they're not going to test you. If they know you're not going to die, they don't want to test you. So the testing numbers are ridiculously low. So a better way to look at this is to say, again, the blue line here is number of people confirmed to have died from COVID-19. The purple line is an estimate of how many people actually had it based on a 1% mortality rate. Why 1%? Well, in controlled cases, cruise ships, prisons, there's a collection of studies that have been done where they test everybody so that they know exactly how many people have it, and then they look at how many people died. And of course, you adjust for, it appears that the average mortality rate is around 1%. So if today we have about 20,000 deaths, then it means 3 weeks ago we had about 2 million cases. And that sounds huge. It's kind of mind-blowing in that 3 weeks ago we thought we only had about 12,000 cases, when in fact at the time we had 2 million cases. If you extrapolate this forward, based on social distancing, it looks like the transmission rate has slowed to about a factor of 1.4. It's still spreading, but much more slowly. Without social distancing, that transmissibility is somewhere between 4 and 6, based on the most recent data, which makes it much more contagious than the flu, much less contagious than measles. And so social distancing has removed this from every 6 affecting 4 more people down to about, for every 1 person you get another 1.4. That's a huge improvement. If I assume that what's happened the last 3 weeks is that 1.4 factor, then the number of people who actually have this today in the US is between 8 and 9 million people. That's a big number, and it's one that people don't want to say because they don't want to scare people, and I'm not trying to scare you. But there's a big difference between assuming 600,000 people have it and 8 to 9 million people have it. And if you think the US data is bad, if I go back to that Johns Hopkins panel that we were looking at and look at other countries, you'll see the same thing if you look at Italy and Spain and many of these other countries. Their number of cases reported must be about a factor of 10 below what is actually happening. Okay, so this is much more widespread, and it means worldwide we're in the tens of millions of cases, not just 2 million. So what we can conclude from this, I mean, here's just daily life, some observations. If 8 to 9 million Americans have this, then you and I should assume any grocery store, hardware store, financial services branch you walk into, somebody that day will walk in who has it. And since this can survive on a surface for 24 hours, or at least until somebody sterilizes it, any service that you might have to touch, somebody else has had it who's touched it. So you've got to be careful. And the trends are changing. We talk about flattening the curve. That is happening. And the goal of flattening the curve is to get it so that hospitals can manage the load. And we're still undersupplied, so it's not fair to say that they can manage. Even if they have the ventilators and the staff, it's not fair for them to have to wear the same protective equipment for a week, things like that. So a lot needs to be done. On that transmissibility I mentioned, I said 3.9 up to as much as 5 or 6. If it's 3.9, this changes the level that we need to reach for herd immunity. Unfortunately, it means we have to get to where 82% of the population is immune before it will really stop spreading. When we thought the transmission factor was down around 2, then we only had to get to about 50%. But it's a more challenging disease than that. It's it's 10 times more lethal than the flu, and it's at least 5 times more transmissible than the flu. Well, no, I'm exaggerating that, 2.5 times. Still, it's something to be reckoned with. Now, what do we get past the we're at? Clearly, we need ubiquitous testing. We can't make good decisions on bad data. This should be an axiom. I'm sure somebody said it before me. We know this in banking. We know this in a lot of industries. And right now, politicians are trying to make decisions off of some very bad data. The only way to fix that is that we get testing everywhere so that we know who has it. And right now, we're only really confirming about 1 out of 10 cases, and that's not enough. We need good antiviral therapies to lower the mortality rate, because if we lower the mortality rate, we ease the burden on the hospitals, and we can go back to a near normal life sooner. We need to be careful about what this means. There is the antiviral drug developed to fight Ebola, which looks highly effective against coronavirus. But we know the difference between a petri dish and a human is, does it get spread to where it needs to be once it comes into the body? You have to make sure it doesn't get digested, that it does get circulated through the body, that it does interact with the virus and all these things. And many drugs fail when they actually enter the body and have to survive those environments. But tests are going on. It just takes time. Maybe at the end of this month or sometime next month, we'll learn whether the anti-Ebola drug is working. Similar tests are happening on the anti-malarial drug. It's worth pointing out, the reason that drug has a chance to work is that it's an immune system regulator, and some people are dying because their immune system overreacts. But that's the same as actually fighting the virus. And it's the early tests that were done on this medication were extremely flawed. So it's still a lot of testing would need to be done on what is a safe dose, how should it be used in combination with other things. So a lot is not known about antiviral therapies, but we're going to get there. So over the next couple of months, we will learn a lot, and things can be done quickly. We need antibody tests. We need to know who is safe in the sense that they've had it and that they have an immunity to it and they can go back to normal life. Now, there are a lot of antibody tests going out on the market, and you may have heard the same NPR story I did, where they claim 90% effectiveness or 99% effectiveness. 99% effectiveness means a 1% false positive rate. Right now, if less than 1% of the population, we assume 1% false positive rate on the test, that's still a random result. That's still not going to tell you who actually is safe to go about their life. So a lot of work still needs to be done on these tests. And anything that says 90% effective is absolutely useless. Don't waste your money on those. And then contact tracing. Contact tracing is at the bottom of my list because a lot has to happen before we can actually trace contacts. We can't trace contacts on 8 million people. We've got to get it down to where the active number of cases is in the tens or hundreds of thousands at most, and then we can start contact tracing. So a lot of work to do here, but a lot of promise. Vaccines are not on my list. They're still 12 to 18 months away, and we're going to have to figure out how to live with this long before those things come on the market. What this all means is to think about different scenarios. There is one where people talk about, well, why don't we just let it burn? And in my early thinking about this, I was thinking, well, why don't we aggressively protect the at-risk groups, put in some basic social controls like canceling high-density gatherings, and let most people go about their lives. Well, that works as long as you know you've got supplies for hospitals and that that you know who has it. You have to be able to test. And what I learned that I didn't know in January is that we don't have the hospital capacity. We don't have the testing capacity. And so letting it burn, that's just risky. I could use some other phrases to describe that, but let's just say that's probably too risky for us to follow. At the other extreme, if we don't get any of the technologies on that previous slide, we're not going to have a choice. We're going to have to stick with long-term aggressive social controls. And that's harsh. It will minimize human cost, but the economic cost is going to be dramatic. And, you know, we want to balance both of these things. We want something in the middle here, which is that we minimize the deaths due to this and at the same time not totally destroy our economy and our country. So how do we do that? We need some of the things I mentioned on the previous slide. We need ubiquitous testing. We need some effective antiviral therapies. We need some antibody immunity tests that work. We will have to maintain some modified social distancing rules. You know, they talk about, could they reopen restaurants with only half the, but can a restaurant stay open with half the seating capacity? Most of them run on very narrow margins. The answer is maybe not. Can airlines run with planes that are half full or a third full? Or would you want to fly an airplane no matter what? Maybe not. There's no doubt that concerts, sporting events, conventions, bars, these things stay closed. There's no way to have a high density event until we've really got this thing beaten. And so I, for one, don't plan to be at any conferences this year. It's just not going to happen. So another look at the data, I want to point out, you know, what does it mean to be past the peak? It's good to be optimistic about what that means, but we can't exaggerate what that means. It does not mean that we get to flip the switch and go back to normal life. The blue dots here are the actual daily number of deaths. The red line is an exponential fit. Fortunately, we're not on that exponential curve anymore. The green line is a normal distribution. The data is actually better as a log normal distribution. And that's what a lot of people use to model these things. So it's great that we are where we are, but we've still got half of it to go as far as how many people will ultimately die from this. If we maintain the situation we have today, we're only half done. If we ease up the restrictions without knowing what we need to know or in any kind of a reckless way, we're going to get another wave. Now, it takes 3 weeks for people to die relative to when they get it, and our testing is not very useful right now, so we won't know we've created another wave for about 3 weeks. So this is the problem. It's this long lag between what you do and when you really confirm the impact of it. And so we're going to have to be very thoughtful about how we write new restrictions and define what the new normal is. And I, for one, think that we're going to need some way to know who's safe. Actually, on the one hand, I wish I was already over this because if I was already over it, I would print a pin to wear around and say I'm safe and I could go back about my life. In fact, cheap flights to Hawaii are pretty cheap right now. I might just go on a vacation. But we can't do that. We can't confirm that if you've had it that you're immune. There's a lot we can't do yet. But with what we do now, we're going to have to define this new normal. Now, new normal has a big impact on how we run lending, because we want to get to where we can do lending, and the policies put in place are the winners in the economy. So there's a lot to ask there. If we look at how consumers today are responding, I think in 2009 you heard a lot about strategic default on mortgages. Strategic default, it was a little overblown because a lot of those strategic default studies didn't look by vintage. They didn't consider the fact that the ones who were defaulting were new homeowners with no stake. They might not even be living there. They didn't have any equity built up. It was easy to walk away. You weren't getting strategic default from people who had lived in a home for a long time, had a stake in the community, had some equity in the house. Well, today, I think we're seeing already in the early numbers strategic delinquency, with a lot of programs in place saying, hey, you've lost your job, we understand, so we're putting forbearance programs in place. You don't have to pay your mortgage right away. People are making the decision on how to use their cash. And so on the right, this is I think, a common sequence. Step 1, lose your job. Step 2, file for unemployment. Step 3, receive some government assistance checks, maybe. So unemployment means you're going to get money. The government's sending you money. You may have a little bit of money in the bank. I know most people don't. But even with getting money from the government, you're going to immediately look at ways to save money. And I'll speak from my own experience. I've got 2 daughters in their early 20s living in Los Angeles, lost their jobs working for large corporations, filed for unemployment. I hope they get some checks. But when they asked what to do, I said, hey, call your landlord. See if you really have to pay your rent. Why not save your cash now? Because nobody knows what's coming. And of course, step 5 on here, ask your mortgage lender, ask your auto lender for forbearance. Anybody who will give you a break, they don't know what you're getting yet. So you're going to ask for a break. We're in an age of hoarding. Hoard your cash, hoard your toilet paper, hoard your frozen vegetables, whatever it is. This is actually a smart strategy when you have no idea what's coming. And honestly, none of us have any real idea, any real certainty of what life will be like in 3 months. So don't be surprised that this is what consumers are trying to do. And I think we have to be prepared for flipping the payment hierarchy. In 2009, we talked about how people needed their car. They needed to keep being able to get to work because, online spending and things like that. And lastly, you might pay your mortgage because there was a certain amount of understanding about the mortgage crisis. In 2020, maybe you need to pay your credit card first. Now, you may not want to pay anything. Delinquencies are shooting up, and they may be going up on people who have cash just because they know they don't have to pay right now. But if you're going to pay anything, you might want to keep paying your credit card so you can get your groceries and order off Netflix and so forth. Your car, well, if you're under a stay-at-home order, why pay for your car? Because you're not going anywhere. And of course, people understand that the forbearance programs under mortgage, the CARE Act and things like that. So we need to be prepared for the payment hierarchy being different. Just the early indications I've been seeing based on a few weeks of data. We'll have to see how it evolves. And what do we really want to do? The difference between forbearance and restructure, we've got to think carefully. It really comes down to when will the borrower return to work or the business return. If it's in 3 months, sure, forbearance. If we're really sure that this can be a business that comes back. And so when we think about that middle ground, a new normal where some things come back and some don't, some restaurants, you may say, I work at a successful national chain and they're reopening and we do a lot of takeout business. Maybe the takeout pizza places are going to be fine when we get to new normal if people feel comfortable enough about going to the pickup window and about who's fixing their food. So some restaurants can return. If, on the other hand, concessions stand at the stadium, that's not going to happen. The stadiums aren't going to reopen, at least not in any sense that they were at before. Or if you're in a low-margin restaurant, if they try to reopen, it won't be for long. So it's not enough to talk about a restaurant. There'll be winners and losers, and across other industries as well. So we'll have to think carefully about forbearance, because if they're not going to return to work in 3 months, forbearance isn't going to help. It gets them further in debt, further over their heads, and the same for the lender. Then you really need to be talking about, what can I do for restructuring? If I think they can come back in 12 months, maybe this is where in 12 months we are reopening the stadiums and the concert venues, and all of the supply chain for those things starts to get back in motion. Then a restructuring of debt might get them to that point. Maybe a lot of the CRE loans, the Lshaped, are going to be reopening, and a restructuring will get them there. Some things may never come back, and those are the businesses who can't make it through 12 months. And this will be some restaurants. This will be some strip malls and other things where they can't reasonably make it that far down. So in the case of never, we're going to have to think about that right up front. What do we do about that? And in trying to make this assessment, some lenders are using services for looking at checking and savings accounts to look at the cash flow. If you know that somebody is getting government benefits like unemployment or other types of cash flow that could sustain them, then some kind of a loan rewrite or re-aging makes a lot of sense. So confirming employment, confirming cash flow is going to be much more, and it affects a lot of systems. It's going to be hard to lend in this environment as well. Since lending, I've read some recommendations from your typical strategic consultants where they say follow a zero lending approach and make the borrower prove it to you. That may be a little aggressive. I understand that sentiment. I think you have to work with your borrowers. Maybe it's not just prove it to me. Maybe there's a little give and take there, but it won't even be industry specific. It's going to be business specific, job specific. Is your job coming back, and what's your cash flow? So it's a lot more work to write that loan, which means loan volume is going to be much, much lower, but it doesn't mean there are no good loans out there. I think it's also fair to say this is not the age of FICO score. This is definitely the age of cash flow, because if a forbearance or a restructure is not going to show up as a negative on your FICO, and you're getting money from unemployment and other things, FICO is simply telling you what they were before. Now that's useful. It's useful to know if before the crisis they were a good borrower or a risky borrower. There's no question. But that does not tell you today, because this is a random event. And in biological terms, the big extinction events are not really selective between who deserves to make it and who doesn't. This is a random selection across a lot of people. Good people are failing when they don't deserve it. So FICO is going to tell you what they were before. Cash flow is going to tell you where they can get to. So, and I guess I've already given this slide away, talking ahead of my slides here. But, you know, if a business can reopen, can they be restructured to a low density business? And especially in office places and factories. And we're seeing this in China now. Big industries like Foxconn, who makes iPhones, is bragging about how they're restructuring their factories to be low density, how they've restructured their lunchrooms to have dividers between people so you don't sit face to face with anybody. That is how we're going to make this happen, is that it's the opposite of the high density office places that we've been moving towards. We're going to have to restructure back to low density office places, at least for a while. So the rest I've already mentioned. So how do we chart a course? Of course, we need to know where we are. Here's some recent data. The retail sales, food sales data just came out this week for March. It's a big drop, no surprise there. All business is failing. It definitely depends on who you are. And on a percentage basis, we're almost back to the total drop incurred in 2009. but we're not back to 2009 levels. We've still had economic growth since then. Vehicle sales, on the other hand, the amount of drop again is almost equal to the cumulative drop experienced in the last recession. Not yet back to the low point of the last recession, but we know this is still going down. All these numbers are not for a complete month of what we've seen. And keep in mind, the initial unemployment claims that have happened so far, in fact, I'll wait for that. We've got a slide coming up. I'll come back to that point. Industrial production is falling. We don't know how much that's going to fall. Initial unemployment claims, this is the graph you've seen everywhere, where you can stretch this back through many prior recessions that we've never seen it. Point out that many models, many stress test models, look at rate of change in things like unemployment rate or initial claims. And a rate of change model has never seen a point like this before. This is so far outside the training data that if it doesn't totally blow up the model has to be very suspect. You've got to assume that there's a lot of model risk right now, whether it's a scoring model or a stress test model, you name it. Every model out there is prone to failure right now. So some are more robust than others. I'll brag for a moment, our own models haven't failed this way, but yes, it's still outside the training data for the models. So we've got to go back and review those things. Here's the actual list of initial unemployment claims. This was spread out a little bit just because the systems file their claim. But in the next couple of weeks, this may slow down. But there could be another wave coming next month because of working our way through the supply chain. This first wave of layoffs and business closures affects another circle and so on. So this is not likely to be the end. We'll have to see what else comes. The unemployment rate was reported for March at 4.4. It should have been closer to 5.4 because a full 1% were listed as did not show up for work. That's a huge percentage. And that really, it's probably, they may not have shown up for work, but really they're going to be unemployed. And with the initial claims that have been reported so far, the estimates are that this month's unemployment number is going to be closer to 15%, of course, and we're not done yet. And question came in, this is a good time to go ahead and ask this. Have we looked at the Morgan Stanley projections and are they reasonable? They are severe. They are more severe than a lot of other people hope. They're not unreasonable. It is entirely possible that we have something like what they had. Now, their projections are very severe for about 2 quarters and then a very strong rebound, so that their net for the year is about a 5%, 6% drop. Cumulatively, that's not outside the range of most economists, not all that much. I think more severe than Morgan Stanley is if you see a drop like they're saying in the next 2 quarters without the big rebound. That's the real severe scenario. We haven't even gone there yet as far as the scenarios we're running. I don't want to call it a doomsday scenario, but that pushes us a whole lot closer to the depression scenario. Right now, we're just looking at what a severe recession scenario might be. I'm going to take a quick peek at a couple of other questions coming in. We've got one on CECL and IFRS 9. I'll have some slides on that. And also a question about probability weighting on these scenarios. Those are good questions. I'll talk some more about scenarios in a minute, and all I can really give you is my gut feel. That's all anybody has on probability weights for these scenarios, but I'll make that point again. So here's some scenarios that we're running right now. We have a COVID-19 mild recession scenario. We created this in the beginning of February, and we're still running it kind of to bound things. Back in February, we thought, this is probably what will happen. And I was assuming that we would have testing like other countries. I was assuming that we'd be proactive enough that we could do contact tracing and that we would quickly suspend high density events. This didn't happen. I'm sorry to say, it didn't happen partly because we didn't have the testing. We all know that story. It also didn't happen because I and many others didn't realize what hospital capacity was. That on a regular day, hospitals are almost at capacity. The only way they could handle this surge was to suspend a lot of voluntary surgeries and other things, and that even then they didn't have enough respirators and masks and gowns and so forth. So I may be a PhD, I missed that. And it meant that what I hoped would be a mild recession just wasn't going to happen. Instead, more likely was the adverse recession scenario. This quickly became our base case, which was saying, looks like unemployment's going to be near 10%, GDP decline in a quarter, 10%. This was my base case by the end of February. Unfortunately, it's looking more and more optimistic because we still didn't have the technology needed to return to near normal in the span of a few months, which was the hope. In fact, what we're calling severe is what it's looking more like, economically speaking. We have technology lags. We continue to face lockdowns. We may have another wave or two of infection depending on how we handle things on our restrictions. Now, the question is, if the economy looks more like, maybe your best case on the economy today is somewhere between the adverse and severe that I've got here. Maybe your worst case is more like the Goldman Sachs or JP Morgan scenarios, or even a bit more. But these are how the economic variables look. If you run this through your stress test model, that's not the same as what answer you're going to get for losses. I think it's fair to say that your losses will not be as bad as what you would get if you run the severe recession scenario, because nothing in these models adjusts for the unemployment benefits, for the assistance checks in the mail, or for the next wave of support from the government that's probably going to happen. I don't think we're done. And so a lot of these things, and forbearance will help some people. It may not help everybody, but it will help some. And re-aging rewrites will help some. So the net of all of that is probably that even if I tell you I think a severe recession is likely, the impact to your business as a lender is probably more like the adverse scenario. I think it's likely enough that it's fair to assume that today until we see how things evolve, that it's equivalent to saying it's fair to have a negative Q factor, that start with what your model says, the model you built before, and then fold in as best you can intuitively what all this government assistance is going to be. Because any stress test model we make is built on the past. It's looking at the relationship between unemployment and house prices and GDP. And in saying that, if we're using that to model on, you have to remember that unemployment benefits were extended out to 99 weeks. That's a lot. There was a lot of assistance in 2009. There were assistance checks in the mail. And so the model sees some of that, but already the magnitude of assistance now is much greater than it was then. So it won't see everything that's happening today. And a couple more questions coming in. I'm going to try to keep taking these as they come because they are timely as we're talking. So do I think it's going to be a V, a U, or an L for the recovery? The V-shaped recession, that discussion started initially when people were looking at Hong Kong. Hong Kong was very much a V-shaped recession. And it's because we didn't have the global supply chain collapse that we're having today. All that happened was people in Hong Kong were afraid of catching the disease. They were put on lockdown or voluntarily chose to stay at home. Unemployment rose, GDP fell. As soon as people feel safe, which happened pretty quickly, they went back, resumed their normal life. They literally flipped the switch and restarted the economy. We don't have the technology to flip that switch. I think there really is no opportunity for a V. We just can't do it. So the real choice is, will it be a U or an L? And I think that is the real risk here. It might be a U if the antivirals work, if the testing ramps up, those are both big things. If we know the mortality testing is getting better, we need to be able to put ourselves back into kind of a U. Maybe it's kind of a, we don't have a letter that looks like that, but a steep drop and a somewhat slower recovery into the early part of next year. That's my hope, honestly, right now. And L, where this just lags for a long time, well, that's what happens if we really just can't get the global supply chain restarted, because this isn't only about us. It's about all the countries that we trade with and the supply chains being able to restart. The Chinese are coming back. A lot of other countries are not there yet. And so what causes the L, maybe it's that the technologies don't work, but also it can be that the other countries that we are interdependent with can't get restarted either. You know, this disease is still ramping up in South America, Central America. We don't, Mexico and countries that are really part of our economy. So I'd say it's a U or an L, and I'm hoping for a U. But when you're doing your business planning, this is a webinar about stress testing. You need to ask yourself what happens if it's an L. What impact does that have on your account management and your new loan origination underwriting? Somebody asked about my assumption of a 1% mortality rate, and yeah, 1% is a little optimistic. There are some studies that say it could be as good as 0.8. Any country level study, the best number is closer to 2%, but you don't have complete testing. And the Russian government just said that they claim that they're one of the most aggressive testers out there, and that 30% of the people whoever and never have gotten tested if they hadn't gone out and tested them. That's why I'm hopeful the mortality rate is closer to 1% than 2%. If it is 2%, then instead of saying 8 million people, it's more like 4 million or 5 million. Okay, fair enough. It's still a lot of people. So I'd still plan for it being a lot more people out there than we know. So here's what we've done. We have models, and models off of FDIC data, NCUA data. We've gone out and applied those models to lots of different companies. So what does it mean if I tell you, here's what our mild, adverse, and severe scenarios look like? The mild recession scenario really was a V, and that V-shaped recession would only have been, losses over a year. Wouldn't that have been nice? That's not going to happen. The adverse recession scenario, which hopefully this could be what a U-shaped recession actually looks like in terms of your actual losses, even if that U looks more like my severe scenario. That's about a 50% increase, meaning that we're hoping that the rest of what might have happened is mitigated by government action. Our severe recession scenario, which is kind of this sagging U, it's a U but with a longer time to recover, 121% increase over 12 months. It's a big number. Could it be worse than that? Yes. If it's truly an L, if it really does drag into depression, it's going to be worse than that. So this is not the worst you could see. But right now, with what we know, I'm hoping it's somewhere between that 50 and 120% number. Now, interestingly, we went ahead and ran CECL too. I know most of the people on this call are not yet CECL compliant, but some are. And the CECL loss reserve numbers are higher than a 12-month number. For most institutions, I'd say it's around a factor of 2 when you blend in all the long-term products. But the irony is that if you're running a 24-month reasonable and supportable period like we are, if the recession really only lingers through a 12-month period and beyond that you're reverting back to the average, and then the rest of the life is for an average economic environment, then your CECL estimate is less sensitive than your 12-month estimate. It's equivalent to saying if FAS 5 were forward-looking, it would be more volatile than CECL. And that's just intuitively obvious because CECL number a lot of it is not responsive to the economy. Of course, a lot of people were doing FAS 5 with a backward-looking moving average, which wouldn't have been responsive. And so that's why this 12-month loss projection is not exactly what a lot of people are doing for FAS 5. But on a forward-looking basis, CECL is about half as responsive as a 12-month projection based on the kind of recession we hope we're going to have right now. So a couple of points here. These are gross loss numbers. I got to make that point. I did not do stress on recoveries. A lot of times recoveries can be stretched out. We really don't know yet what the impact to house prices and used car prices are going to be. I mean, obviously they're falling, but will they stay down or will they come back by the time you have? These are just gross loss estimates, which obviously could be worse. And so when you look at people who've been reporting their change in their loss reserves, their CECL numbers, and you're seeing them report increases of 350%, 450%, getting them back relative to last year, right? Taking them back to the kind of loss reserve numbers they had for the 2009 recession, I'm sure they factored a lot of things in there. I'm sure they factored in lower recovery. I'm sure they factored in more on the severe side of the recession and so forth, because you know it is often the case if you're going to write down a big number, a lot of folks will choose to do it in a big way instead of lots of small pieces. My guess is that that's what they've done. So that's what we're seeing right now. These scenarios you've heard me mention before. This service, this is where we take inputs on GDP and unemployment and then use this ensemble of deep learning neural nets in order to populate all the other factors and run them through the models that we've had before. So I will point out, I don't do a lot of sales pitches. I really try to keep these things informative, but as information, you might like to know that we can run the same report for you because you don't have to give us data. We've already got top-down models off of FDIC and CUA. So if you wanted this, we can run a custom report for not much money, and we'll throw in a free year subscription to Scenario AI so you can see the updated scenarios going forward. That's the only sales pitch there. Here are some references. We'll make the slides available if you want to go look up some of where these numbers came from. There's lots of numbers out there, and I totally, transmission factors, the mortality rates, all of these things are early guesses. So we'll keep an eye on that. So thanks for your time. I'm taking a quick look to see any other questions that might have come through. There's a question here that says big banks should raise lots of capital now. 200 billion is the number that the question asked. Do I think they should be raising a lot of capital now? I think that's the purpose of stress testing. There is a real risk, and the IMF is saying this, that the global economic growth can lag so much and the global supply chain come back slowly enough. And the new normal, you know, when we say the news and say that we're open for business again, it's not business as it was before. So we do need to consider what it could look like if we really had that L-shaped recession. And I, for one, would want to be prepared to deal with an L-shaped recession. It doesn't mean that I need to take down all the capital necessary to survive that today, but I would want to have a plan. And I haven't had that job. I haven't managed bank capital on a day-to-day basis myself. I'm the models guy. So I'll leave it to them to decide, looking at the liquidity in the market and what the Fed is willing to do, whether they have to take it now or later. Sounds like the Fed is willing to support them if they take it a little bit later, but you better know what your number is, and probably some big banks are having very senior discussions with the Fed about what that number might be, I would assume. There's a question here about risk of US default if we keep printing money. Fair enough. We are going to come through this with World War II levels of debt. I think there's really not much question about that. We survived World War II debt. We had to finance that over many decades. And if you're going to finance it, you have to plan on paying it back. I don't expect the U.S. will want to default. Iceland chose to default, and they got away with it. They've had a pretty good recovery. But the U.S. is so tied to so many other countries, I'm not sure that a default is an option. I do think we're going to have to rethink our balance sheet, and that's revenue and expense. Delve too far into politics. The U.S. runs a balance sheet, and it has two columns, and you can adjust either one, and there are many different views. This is basically how politics falls, is whether people want to adjust one side of that balance sheet or the other, and compromise is always the best answer. So we'll have to see. I think we don't know enough today to know how dramatic that's going to have to be, but I'm sure something will be done. Question here on how might the November election change the course, and do I think that there will be an election? There will be an election because the courts are going to say that it's in our contract, it's in the Constitution. There will be an election. I think it's going to be chaotic because there's going to be a lot of, I for one plan to vote absentee because my state lets me do it pretty much at will. So the new normal is not a normal where I want to wait in a long line with a bunch of other people. Even in November, you won't find me at a voting booth. So I think it may change habits a lot. It's certainly going to change the nature of the election. It's going to be pretty funny if they put two candidates on stage for a debate, both wearing masks. I wish they would. I think it'd be hysterical. But it will be an election unlike we've had before, that much I'm sure. I'm not going to predict the outcome. That's not my business. Go to 538.com if you want that. There is a question about high-risk industries, and initially people were asking me about high-risk geographies. I think we're getting pretty quickly past the notion. I do want to make a point here as you think about the US that great things have been done in New Zealand, in Taiwan. The Singaporeans are doing their best to maintain their initial success, although they're struggling through their second wave. Same can be said of Hong Kong. They're struggling through a second wave of reinfection, but they're doing their best. Those are the biggest success stories, and what do they all have in common? They're all islands. New Zealand, Taiwan, Singapore, Hong Kong, they're islands. And, or at least, Hong Kong spreads a bit across the ocean there, but they've got defensible boundaries. They're geographically small and compact. The US is none of those. The US, you might say, looks more like the path of the Chinese. Well, even there, China had a single point of origin for this. It had Wuhan, it had Hubei, and they locked it down. And they locked it down in a way that apparently isn't even legal in this country. They basically had military outposts on the highways, and you will not leave, period. There's no way we're going to put tanks on the bridges around New York and San Francisco and things like that. And it means in the US, first of all, we don't have one point of origin. Because of the way it's spread to the US, every major city is now or could be in the future a hotspot. All the states are interconnected. If one state does nothing, it will become a hotspot and it will reinfect all the other states. That's the reality of having 50 states, a big geographically distributed country. Start here so it infected here all over the place at once. So we're not New Zealand, we're not China. We've got kind of a worst case situation from all of these, and we're just going to have to fight through it with our new normal. Okay, so that's why our situation is different, along with a lot of other things. We could have done a lot of other things differently, maybe. I'm not going to replay that, but our future is going to be different.
Joe, you have a chat, just a chat saying, but the UK is an island and not doing very well.
Okay, well, the UK, good point. The UK did not do what, and I know not everybody reads the news I read. And it's because I've got friends around the world. I've worked in many countries around the world, so I'm just used to reading that news. So I've read in detail. Taiwan had been through this before with diseases coming out of China. They were ready for it. They had a plan. As soon as it was announced, they started executing it. So in January, any flight coming from Hubei, landing into Taiwan, they didn't let people deplane until they did health checks. They took down their names, their phone numbers, and they tracked them after they left the airport. So even if they were asymptomatic, they kept track of them. If they later became sick, they traced their contacts, first order contacts, second order contacts. It was done right, and it was done that way from the beginning, and it never really spread in Taiwan. UK didn't do that. The UK said, we're going to ride it out. And that's a strategy that, you could say, hey, it's a bad flu, I get that, we're going to ride it out. And that's what I thought we were going to do because we couldn't be Taiwan. But writing it out made some big assumptions about what the hospitals can handle and some other things. And they got it wrong. The UK got it wrong, we got it wrong in that regard. I got it wrong in not realizing that hospitals don't have that capacity. So yeah, the ride it out was not a good strategy. And anyway, there's a question here. When unemployment improves, it seems that households won't be in a buying mood. So how will that impact demand and improving unemployment long term? Even when they start reopening restaurants, I can tell you, I'm not in the mood to go to a restaurant because I don't trust that we have done what we need to make it safe. I know that we haven't. We can declare that we're past the peak, and so social distancing and reopen things up again. But why should I do that? Why should I put myself at unnecessary risk? My mother, in her 70s, I think enjoyed working as hostess at a restaurant in South Carolina where she lived. I got her to quit her job way back in February. And she's told me she won't be going back to that job anytime soon, and she won't be going back to a restaurant no matter when people tell her she can, because she's at risk. Until this is really beaten, until there's a vaccine, she won't be going back to a restaurant. I agree. So the new normal is going to last a long time, and it means that that U-shaped recession is going to sag. It's not going to be a true U because a lot of businesses aren't really going to come back for a while. So, and again, another question about uneven distribution of unemployment and future employment opportunities, and how might that impact different products and industries. And, we'll have to see. It's, I think, success or reemergence from this. A lot of businesses are going to have to rethink how they work. We may lose a lot of restaurants, but if we're smart, Americans are pretty innovative. It's what makes our economy grow and resilient. So where can we put our hope? Our hope is reinventing. What are business, we talk a lot about restaurants. What are they going to do to recover? What does it mean as far as creating a new kind of restaurant experience? Stores are not going to keep people lined up down the sidewalk 6 feet apart forever. They're going to have to rethink how retail is done. So the online and storefront experience may have to become more of a hybrid than it has been. It's going to push us to rethinking a lot of our businesses and how they're done. So I don't know yet. I don't run any of those businesses. But I think that's where the new jobs are going to come from, are the creative folks who think of a new way to do old businesses so that we can live this new normal. If you know, and this is where my advice is, if you know the new normal is for 12 to 18 months, then create the new business to thrive in the new normal. And those are the people I'd like to lend to be honest. About leveraged lending through those 3 different scenarios. And yeah, I think lending is going to be very cautionary. In fact, I'm going to diverge from this question a little bit and say one thing we're seeing right now is funding sources are a big issue, that you know, actually savings are going up. Credit unions and community banks may be in a good position to make high quality loans today. The fintech competitors to those businesses, I can tell you, some of them have worked out partnerships with banks and credit unions, and so they're okay because, you know, they originate and pass the loans on to them, and if they can really focus on high quality loans, they're fine. A lot of fintechs were backed investment funds, and those funds seized up almost immediately, and so I've heard that a lot of fintechs that we know of, or in fact a lot of smaller ones who are just getting started that we may not have all heard about, they may evaporate overnight. So the last recession brought in the era of the fintech. This time, by government support and everything, the winners and losers could shift dramatically, and it could be hard times for the fintechs. So we'll see. I appreciate the level of interest and interaction. This has been great, and I won't plan exactly when we'll do this again, but you know, maybe 4 to 6 weeks from now, if we've got something different to talk about, because we'll know a lot more then we may have another update. Between now and then, we did actually finish a CECL credit card study that was years in the making, and it got released back in late January and February, right when all this hit, and really hasn't gotten any attention. Perhaps in a few weeks we'll have a webinar on our CECL credit card study. Until then, thank you all, and we'll